Madhav Dhar is with us from Delhi. Madhav, good morning. Great to have you with us here. Appreciate your time. Prashant this side. We last spoke on the 4th of March. The Nifty was about 7,500, 74.85 that day close. We're not very far from that point. Got to about 7,800 and then as the market has climbed down again. Before we get to specifically India, I just want to get your overall sense. The first quarter, Jan to March, was all about oil and stocks around the world were very closely coupled. Second quarter so far, although it's too early, seems to be about currencies. Look at what the yen is doing, the euro, emerging market currencies, but it's mostly been about the yen so far, 107 nearly to a dollar.
Yeah.
What's really going on and what should we sort of expect to happen as far as the world of stocks go because of what's happening in the currency markets?
Well, I'm not sure they're entirely related stories. I think what we've seen is something we talked about, I guess, at the beginning of the year, where we had a very, very bad first month, that you had a global synchronized growth panic, which was, I guess, exemplified best by the price of oil. So everything created, all growth assets created, and as you and I talked on budget day, that was a very important low, not just for India, but for the world and for risk and growth assets. Since then, you've had a huge rebound, and some of the most cyclically exposed sectors and countries and currencies have had a big bounce. And now I think we are in a sort of sideways or a fadeaway phase after that huge decline and huge explosion of that. And I think we'll sort of see how it plays out to some extent. I think the dollar had been massively overbought. So I think it's going through certain sort of correction or readjustment from that process. But I think the most important thing is still what really happens to the U.S. economy. And that really dictates what happens to world growth, eventually dictates what happens to growth assets. And that, I think, is really complex. It really is complex. I think the U.S. economy has done extremely well, relatively speaking, over the last 2 or 3 years. I think there was this real concern that the Fed was tightening a little too soon. The Fed seems to have practically agreed to that assessment by the markets and is fading back. So we are in this funny twilight zone of still plentiful liquidity, and every time the central banks back off, growth assets go up. And after they sort of run their course or they exhaust themselves, either in terms of money coming in or the Fed saying something, they retreat. So we are in this funny sort of twilight zone, I feel, and I feel actually very ambivalent. I mean, I don't feel very convinced that this is going to break out one way or the other. So I'm in the wait or watch mode myself, frankly. I mean, there are times when you don't have a disagreement with the market, and this is one of those times. 2 months ago I did, and we talked about it. But some of that disagreement with the market, which is I thought things were too pessimistic, has been violently corrected. So I'm back to sort of in line with the world view, which makes me sort of inactive and bored, in the sense that you just wait to see what happens.
Fair enough. Just to come back to the currency, not in terms of the impact it has on stocks directly, although in some cases it does.
Yeah.
But really, I mean, this big thing called the yen carry trade. I mean, I remember it comes back and gets talked about quite a bit every couple of years, right? I mean, the yen is the strongest it has been in the last 20 months or so. How does it play out? I mean, just explain it to our viewers, Madhav. What is really the yen carry trade and how big is it?
It plays out in the sense...
And what happens? Yes.
Well, I think you've had this situation several times. I mean, for those who don't follow it very closely, Japan has basically gone ex-growth since the end of 1989. So you've had basically 26, 27 years of near zero interest rates. And so it's been very, very tempting to borrow in yen at very low rates and speculate on something else. And it goes very well till it turns violently against you when the yen strengthens, especially if you're borrowing in that currency. So that's the nature of sort of speculative carry trades, that they work till they explode, and LTCM famously blew up in 1998, essentially, levered 30 or 40 to 1 on similar trades. And many hedge funds have both succeeded and blown up as a result of it. So that's simply borrowing at a very, very low interest rate, where the central bank has told you what they're going to do, and you take the other side of it, and it seems to work for a while and ends very, very badly usually. So I don't think that's. I can't imagine that's tremendously relevant for your viewers. But I think what is important is the impact it's going to have on trade, and I think already it's beginning to have that effect. You will see, yen-sensitive assets in India under pressure. Especially when you're importing from Japan, and some of the car companies, as you know, are in the eye of the storm. So that's something to look at and to worry about. On the other hand, Indian exports have been extremely weak. So as some of these Asian currencies perhaps strengthen on the back of the yen, maybe our exports will look a little better. So I think it's still early days to see how this all plays out.
Okay. But broadly, from an overall perspective, you're saying that the lull that we are in right now, that we find ourselves in, it's not a precursor for blue skies, neither is it, a precursor to end up in the eye of a storm. Nothing. Neither of those two. It's essentially bounced off the lows and now nowhere to go.
I'm saying I don't know. I'm saying it could well be one or the other. I'm just saying that I find myself in a sort of a neutral position, in the sense I don't really have a strong sense that it will break out one way or the other, and I don't think assets are priced that it pays to take a very big position. You and I talked a budget day. I think it made a lot of sense to take a very aggressive view of the implications for the budget and how Indian assets were positioned. I thought it made tremendous sense to make a very aggressive bet on risk assets and commodities and real estate and so on. And I did. And since then, you've had huge moves. I talked about a couple of stocks, which I never really talk about. It's up 50% from 2 months ago. So that's a huge change in pricing. So and at this level, therefore, I sort of feel, as I said, neutral about everything. The S&P has bounced 10 or 12%. India has bounced 14%. Some of these risk assets have bounced 20, 30, 50%. The global mining stocks are at a huge move. So I'm just saying that it's not the adjustment I thought that needed to be corrected has happened very, very quickly. Oil has gone from 28 to 40 something in no time. So it's either time or price, and this time the price has adjusted in very, very quick time. So I think, again, as I said, I don't really have a differential view of the market. And frankly, I almost refused to come on your show today because I really had nothing to say.
Imagine my plight, Madhav.
But okay, I'll tell you what I am encouraged about. I'm encouraged. Go ahead.
No, sorry. Go on. Please complete that point.
No, I just think that I think it's going to be very slow moving, but I think what is still being underestimated is the start of banking reform, liquidity injections into the Indian system, banks taking their write-offs more seriously, and sort of the start of the cleansing process. I think it's clearly underway, and I think it's still being poo-pooed. It's still being underestimated. Oh, they have a long way to go. You don't understand, etc. So my gut instinct is more is going on within the banks, certainly with the central bank, and between coordination of the administration and the central bank, and all of that is slow moving, and all of that I think is fantastic. And I think it will start the blood circulating in the Indian corporate body, and I think that's the start of a cycle, and I think the odds are extremely high that we've seen the low of the Indian corporate cycle. The analyst estimates, which I certainly treat with some skepticism, frankly, but are starting to pick up quite sharply. and the estimates are that the earnings would be up 14% in this coming quarter, and I frankly don't have a disagreement with that. If that happens, we're coming off an extremely depressed earnings cycle, an extremely depressed economic cycle, and I think you're going to start seeing the release of a earnings pickup and greater liquidity that sort of courses through the system, and the corporate sector slowly delevers more, public spending picks up a little bit, the economic momentum picks up a little bit, shows up in profits, much more than people realize, because the operating margin will go the other way. So I think all of that is starting to happen, and some of it was very gently signaled in the RBI's policy, that they're much more focused on actual liquidity, not just the headlines of what the rates are. So I think that's good stuff.
Does it make sense to buy bonds, Madhav? Because if you think the efforts will result in cost of capital coming off meaningfully, does it still make sense to lock in these yields, play for appreciation in the price, or you think that was last year?
To some extent.
I think it still could come off.
I think that was. Yeah, sorry. I think it was better last year. It's still probably good. I think it's really a function of your risk appetite as well. I guess my point is that if I'm broadly right about the Indian macro situation unfolding, I think, as I said to you a couple of months ago, banks directly, equity of the banks, equity of some higher quality real estate companies will be much more levered plays. So, the way I approach things, I sort of tend to have a view of how the world or how India will unfold, and try to see at different risk levels what assets make more sense. So in that sense, government bonds at the lowest end, some high quality corporate bonds there, then something like, my bet on State Bank of India or some of the bank stocks that I think are undervalued. Third, and if you want to get really aggressive, I think you buy some of the real estate companies, that even though they have a complicated set of difficulties, I think all of them are easing at the same time, and they're easing at a time that everybody has completely written off the real estate cycle and the real estate sector. So that's how you play it. So I think all of it could make sense, depending how what your risk appetite is. Mine tends to be very high.
Threshold for pain as well, right, Madhav? There also has to be, it's different for different people.
Yeah.
But it has, yeah.
Absolutely. So I'm not advocating it at all. I'm just suggesting that there are very different ways to play the same macroeconomic projection. And that really depends.
You're telling me that your simple and big bet to play the cycle is State Bank of India. I remember, you told me that in March when we chatted.
Well, I have only mentioned two stocks ever on your channel, State Bank of India and DLF. So I bought both of them on budget days. We talked about it. And, they've obviously bounced extremely well, DLF particularly, and we'll just see how it goes. I just said, and I don't have any, bottom-up, stock-specific insight or view at all. It's undervalued. Those are both undervalued leaders in sectors that people are worried and skeptical about. So just thematically, I like that. And that's the end of it. And I just think that if India goes from 7-ish% growth to 8.5% growth over the next 18 months and accelerating, I think there'll be fantastic plays after everything that they've been through and the way they are priced. And as I said, I think there are risky assets. One is more risky than the other, but all of them are risky. But that's the nature of equity investing, and you really have to have at least a 5-year view to this sort of stuff, and you don't want to second guess yourself quarter by quarter or month by month, and let alone day by day. And so that remains my view. And I tend to be lazy. I think every 3 or 4 months, unlike you, who thinks every morning. So I thought a lot about stuff 2 months ago, and I'm done.
Okay, fair enough. I remember you telling me about real estate in Delhi, for example, right? It's a big, not just the impact it can have on stocks, but then the economy. It's a big area into which a lot of money went over the years, right? And then for the last couple of years, property prices have been coming off, and even not rising is costing people money. Prices not going up is costing people money because rates have been 9-10%. So that's the minimum hurdle that prices had to cross every year. What's really going on? I mean, are you hearing anything on the ground? Are things improving, getting better, or they're still pretty bad?
I think I'm not. I think things are leveling off. They're bottoming out. And from what I mean, again, real estate tends to be a very local market and a fragmented market. It's hard to generalize, but I think if you were to generalize, you're at a peak in about 2011, 2012. So you're 4 or 5 years into a vicious down cycle, and real estate cycles are very long, and all the real estate bulls, and everybody was bullish as far as I can remember. And it takes a long time to kill that mindset. And it's finally getting killed slowly. And we talked about it 3 or 4 years ago, that one of the reasons to be optimistic about equities structurally in India is that the two competing assets over the last generation are going to die, which is real estate and gold. And the money will then flow to more productive assets that's good for the economy, which is stocks and bonds. And I think these are very slow-moving changes because those are underway. So just to be clear, I mean, I'm not optimistic that the real estate cycle in India has turned, it's going to be fantastic, or we'll see anything like what we saw in 2002, 2012. Not at all. I'm simply saying that stock prices can quadruple of extremely depressed lows when they go down 80 or 90%, when things just go from being terrible to bad. And I think that is hard to analyze and harder to conceptualize, let alone execute. So I think things for real estate in Delhi or India have gone from terrible to bad. That's why I'm buying. And stocks, my guess is the real estate sector will be up 50% when it goes from terrible to bad, will go up another 100% when it goes from bad to okay, and probably another 100% when it goes from okay to good. And when things look good, you want to get out. So that's certainly the way I look at things. So I tend to be early on things, and this may be early as well. So at the same reason, I bought commodities and so on. I'm not very optimistic that the global economy is going to accelerate significantly to a new economic cycle. I just think economically sensitive assets have overshot where they should be relative to where growth is. And I'm not very optimistic on growth. I just find a huge pricing discrepancy. So you can call it that it may just be a trade, but it could be a heck of a trade. A interesting analogy would be that eBay, Yahoo, Amazon, these stocks did better from 2002 to 2005 post the NASDAQ bust than they did in percentage term in the NASDAQ boom from 95 to 2000. So what happens is when something goes down 90% high to low, it has to go up 1,000% to get to the same level. The simple arithmetic. So in the end, I don't care about the absolute value of Amazon or the absolute value of where the stock price is for State Bank of India or DLF. I care about off the low, what's the percentage change that it's in my pocket. So, DLF is up 50% since we spoke about it, and you can't even tell on a chart, it's just a little blip. So that's the conceptual point I'm making, is that truly busted up things that overshoot fair value just simply have to get less bad for you to make a lot of money on it. And the analytical obsession, understandably, human nature being what it is, you need to justify to each other that you're buying something that's very good and you want to tell stories. This is a great story. We always hear about it. What's the India story? I've never heard of somebody say, well, what's the India valuation? It's always the India story. Is the India story good or is the India story bad? And the sad thing is the story actually doesn't change very much. The valuation changes, sentiment changes, and you need to capitalize on those things, whether it's at the global level or at the Sensex level or in sectors or in stocks. And that's certainly the way I think about things. So all I'm saying is that there's a huge valuation discrepancy, particularly in risk growth assets. Some of it has been violently corrected in the last 3 months, and I think it will probably continue to be corrected, which is my best guess. But it's happened so fast that it's giving me a little bit of pause that, wow, it's adjusted very, very quickly. So I don't really have, as I say, a disagreement with the market. And you must never trade or never get invested if you don't have a disagreement with the market. Because otherwise you're part of the herd.
Yeah.
Herds get killed.
Absolutely. Not if you're in the center of the herd. then you could escape. Anyway,
Not if you're
I think
right now.
beautifully.
Yeah, that's true.
Well, that's beautifully put. Absolutely. You're buying because things are going from terrible to bad. That's some way to put it.
Yeah.
For banks, Madhav, so the earnings season is upon us. All banks told us, except Bank of Baroda, which you and I discussed, that they said we've recognized everything and provided everything we needed to in the last quarter, October to December. But most of the banks, I spoke with the SBI CFO 2 or 3 days back, and she said, well, we provided 50% of the bad loans, provided for 50% of the bad loans in the last quarter. The rest will come this quarter. Now, markets look ahead. How do you think people will react to it? I mean, they'll say, okay, another 20,000 crores and we got to provide on these 20,000 crores. Now we are done. But they can't, I mean, they'll say, well, we've provided on all the existing bad stock of loans, but, they can't stop more loans from turning bad. But do you think market will say, okay, the real worry was the numbers that were published were not really true. Now they are true, at least what we know what the bank knows to be, bad loans. Now let's see how the economy kind of fares, and it depends on the economy. So stocks should do well, or you think they'll just languish? What's your view?
I mean, that's a very good question. And I think, there are two separate issues, which is what happens to quality of loans from purely an economic standpoint, and what's the accounting treatment of that, and what's the strategic business view at the top of these banks. And I think Bank of Baroda's getting ahead of things and taking a huge write-off was very unusual in the Indian context and extremely credible and creditable. And again, people, we always talk about whether emerging markets are sophisticated or not, and I think it was an extremely sophisticated reaction where Bank of Baroda went up 20% the day this thing happened. So I think that is telling you that an age-old saying, which is uncertainty is worse than bad news. And I think Bank of Baroda proved it to you, which is you may be uncertain about what our potential losses are. Here they are. Here's the whole damn thing. We've written it off. Immediately, the stock popped up. So I think State Bank of India and the entire banking system should take heed on that, which is it's much better to be completely transparent, aggressive, and take bigger write-offs than you think is completely reasonable. This way you can always write back things. But that will absolutely clear the decks. And I think after the initial pop, and I may be overanalyzing it, but after the initial pop of something like State Bank, which went from 150 something to whatever it was, 190, it has sort of languished. And my own gut instinct is it's languished because you are still not very clear. Okay, some of it has happened. There's more out there. We don't know what monsters are lurking and when they will show their ugly head. So I think it's a statement of the general principle that when somebody suspects something, you must come completely clean. And that's true for everything. I mean, go back to the Vodafone tax issue. And, there are obviously compulsions between the Supreme Court and the government and so on and so forth. But somebody should have got up to say, in no uncertain terms, that Vodafone will never happen again in India, that we will never have this situation. So removing that uncertainty, and I don't want to quibble whether somebody could have said it or not, I'm just making the conceptual point that saying something bluntly, that it will never, once you take uncertainty out, it helps investing, it helps pricing of all kinds, whether it's entire global pricing based on what government policy is, or write-offs based on what a specific bank does, or just coming clean. So the shorter answer to what you're saying is, I think it'll be a bit of a muddling through process because we've not had a full, as they say in America, a whole kitchen sink. You throw everything in and write it off. That hasn't quite fully happened yet. But the process has started, which is what encourages me. The entire talk, activity, action, focus, defaulters list, it's brand new stuff for India. I mean, it's really extremely healthy. And I guess you have to give some rope because these are still government-owned or influenced concerns greatly that are doing very dangerous political things, and you have to take your hat off to that. So I am taking my hat off, and I think it's very credible, and I think these will be good investments. More transparency, bigger write-offs, cleaner, overdoing it, I think it would be better. But it's tough.
Madhav, well put as always. Thank you very much for coming on today, Madhav. Thank you for your time, and it's always
Thanks, Prashant.
great
Thank you.
perspective chatting. Thanks indeed.